Hi everybody, Ron Benjamin here from South Texas with my mascot, Lappy the Leopard, always looking over my shoulder, protecting me, I guess. Anyway, so, one of my clients called today and they had a tax question, and I said, wow, I should talk about that on my video. So thanks to my client, I have another topic to discuss today on lowering your taxes. Now, this one specifically had to deal with, he has a commercial property that he wants to sell, and what are the tax implications? Okay, the one usual tax implication is paying capital gains tax on the sale of that property. Now, I'm not going to get into all the details because it's just going to confuse you. So I just want to make it as simple as possible and use a simple scenario. And then what are you going to do? You're going to email me and say, Ron, hey, I need to set up a phone appointment with you to talk to you about my similar situation. Okay, so he's got a commercial property. He wants to sell, but he doesn't want to pay at this point the capital gains tax that he's going to incur in it. Now, the capital gains tax itself, as other tax regulations, can change from time to time, and usually Congress takes all the way up till December to make the changes that we have to put into use in the following year. Doesn't give us a lot of time to adjust. That's the way it's been for years. Okay, but anyway, the capital gains tax rate can be as high as 20%. So let's say my client is selling his commercial property, which in this case is a warehouse he used in his business. And let's say he bought it for $100,000 years ago, and upon sale, it's now worth $250,000. So what's his gain? How do you figure a gain? It's a simple math computation. You take the value at the time of sale, or at the sale, or on sale. So let's say he sells it for $250,000 and he bought it for $100,000. He's got a $150,000 gain. 250 minus 100 is 150, right? So he has to pay tax on it. Now, what's my philosophy about paying tax on things like that? You're making a profit of 150,000. Uncle Sam just wants his portion of it. No matter what we think about Uncle Sam and his taxing ways, I like to remind my clients, but you made a profit. You still made a profit. Even after you pay the tax, you still made a profit. Okay, but what if you don't have the money to pay the tax? Right? That's an issue. Yes, you're happy to make the profit, but in this scenario, okay, 20% of 15 is what? 30, right? So he has to come up with $30,000 to pay the capital gains tax. So we were talking about ways to defer that tax. I never use the word, remember from my other video, I never use the word to avoid the tax. This is a way to defer the tax. What is it called? 1031, Section 1031 of the IRS tax code. So if I'm quoting a section from the tax code as a resolution to this capital gains tax issue, then you know it's a legal remedy. And that's all I do is legal remedies. Anyway, so this is a really good provision in the tax law that you can take, and this simply is how it works. And it has to work step by step according to IRS regulations. If you mess up some of the steps, you can lose the tax deferment on the gain, on that capital gain. Okay, so after hearing my video and you say, hey, I'm going to try this on my own, don't do that. Like I said, I've been doing this for 17 years as a tax accountant, and before that a investment broker, and I've been doing accounting since 1986. So please, after listening to this video and you have a similar scenario that you want to defer capital gains tax on a property you have, commercial property, and you want to take advantage of this 1031 exchange provision of the tax code, you send me an email and tell me, Ron, I need help. We'll set up a phone appointment and we'll talk. And my email address will be on the screen here. Simply, it's helpme@rpbfinance.com, which is also my website, www.rpbfinance.com. And you can sign up for my weekly newsletters there too to get weekly tax tips. Anyway, getting back to this 1031 exchange. So my client has this issue. And I said, yes, there is a provision. It's called a 1031 exchange, where if you take a business property, commercial property, like in his scenario, it's a warehouse that he used for his business, and exchange it for another commercial property of equal or higher value, you can defer the capital gains tax. And you can defer it for a long time. That's the beauty of it. Okay, so let's say you've exchanged the property and you've got another property and you leave it in your will for the next successor. Could be your spouse, could be your children. It can go all the way to your grandchildren. It can go all the way to your great-grandchildren. That tax is deferred all the way down. That's if that property is still in tax deferment mode, okay? So let's go over some details. It has to be a commercial property. Like in my client's case, it's a warehouse that he was using for his business. It could be a farm, an active farm, rental properties that you own. Those are all considered commercial use. A warehouse like my client has. A commercial building that you lease out offices or spaces to businesses. Those are all commercial properties. So you're saying to me, Ron, I think I heard you say you exchange one property for another. I don't want to deal with the headache of owning another property, and definitely don't want landlord issues. Well, that's the beauty of companies that have properties available for exchange. And in my experience, what these companies do is they keep lists of properties that are eligible to be exchanged for the property you want to get rid of. They're triple net leased. In the scenario where you're exchanging your farm, your rental properties, your warehouse, your office building, you can exchange those kind of commercial properties, business use properties, for a property that McDonald's is leasing, Burger King is leasing, Taco Bell, Petco, you name it, whatever's in your area. They're leasing those properties. They generally do not own those properties. They're leasing them. What's a triple net lease? It means that the tenant, which is like any of those businesses that you see out there in the strip malls and the malls, the properties that fast food restaurants are sitting on and restaurants are sitting on, those properties are going to be triple net leased. That means the tenant has to deal with the issues of property tax, etc. on those properties. You get to enjoy a income stream from that property that you exchanged for, and you have no landlord responsibilities. And your capital gains tax is deferred. Wow. When I get to exchange my property, I don't have to have landlord responsibilities, including the paying of property taxes on that property. My capital gains tax is deferred, and I'm getting a return on my investment for that exchange. Wow. Okay, that is really a great provision in the tax code. And not enough people take advantage of that. As a matter of fact, I have maybe one client who's taken advantage of that in the past 2 years, I'd say. So listen, if you have a scenario like that I'm talking about, a business use property, commercial property, you or your friends or someone you know can use this 1031 exchange of the IRS tax code and get your capital gains deferred, enjoy a return of your investment, and not have to deal with landlord issues on that property. Listen, you got to use those provisions. That's what they're there for. So email me, let me know you want to set up an appointment to talk to me about this. Yes, I charge a fee. As I always say in my videos, I charge a fee for my consultation, and that fee, if we're talking about business properties here, that means you're in business. That fee, my fee, is tax deductible on your tax return. So there's another plus. Okay, anyway, please get a hold of me at helpme@rpbfinance.com. Go to my website, rpbfinance.com, sign up for my weekly newsletters to get my weekly tax tips sent directly to your email. Happy to help you. Happy to save you money in your taxes. Thank you. Have a good one, y'all.